This is Everything Financial Radio. We have the pleasure of chatting once again today with Dr. Chris Martenson. Book that you should read. It's a must-reading, in my opinion, called The Crash Course. And you can read more of Chris's thoughts online at the website, peakprosperity.com. That's peakprosperity.com. Chris, I had a gentleman on the show a few weeks ago who was very bullish on energy, and you've done a lot of writing about not only the economy and the environment, but also energy. He seems to think that this is a good sector in which to be investing moving ahead. Can you give me your comments on his position?
Well, in general, he's absolutely correct. Energy is absolutely essential for any civilized society. To parse it out a little bit, I'm a huge fan of being invested in liquid fuels at this point, petroleum, and ways that we get liquid fuels like petroleum. And I know there's been a lot of talk lately about the shale revolution in the United States. A bit of that's been hyped. Most of it's actually very real, but we're learning some things now. And one of the things we're learning is that there may not be quite as much as we thought, or it might not be quite as easy in certain circumstances. Just recently, the Utica Shale, which underlies the Marcellus, it's this huge swath of shale. People thought it was the next giant thing. 4 companies were drilling into it, and they all gave up and said, we're out of here. So one whole shale basin just got shut down because it didn't work. Poland didn't work for the same reasons. That was an exciting place. So we're finding that the couple of shale basins that we've really gone after, first, the one up in the Bakken, principally the Permian Basin, and also the Eagle Ford shales down in Texas, they're awesome. They are fantastic, just incredible finds, and they're kind of unique and rare in certain respects. Or I should say all shale basins aren't created equal. So there's a little tempering of that story now, and that's an okay thing. That happens whenever you go through booms. The story gets a little ahead of itself, and then reality sets in. The big part of this story is that this energy is not a U.S. thing. If the United States produces more energy, that's good for us, but it doesn't necessarily change the world dynamic for oil. So let's look at the world oil situation. This is where there's a really big story. It's been sitting in plain sight for years. Since 2005, the price of oil on the world market has tripled, and the amount of oil coming out of the ground has gone up by about 2.5% on a worldwide basis from 2005. Now, the second piece of the story is that in 2005, we were spending $300 billion per year worldwide on exploration and production in the oil business. Today, we're spending $600 billion a year. So if you follow along, what just happened was we doubled our expenditures in this area, and we increased our output worldwide by about 3%. So what's really happening in this story is the United States is increasing its production very rapidly through the shale plays, but the rest of the world is depleting very rapidly, and they're kind of at a standstill. I consider a 3% increase to be more or less insignificant in this overall scheme when we're looking at it over 7-year period now. And so world oil is still hard to come by. Everybody knows it's getting tricky to come by, and in this story, I don't see any way that the shale increases, as great as they are going to be able to do anything more than maybe just overcompensate for that decline for maybe the next few years. And then because these shale plays deplete so rapidly, eventually, depletion dynamics take over, and we're right back where we started in this whole thing, which is world's competing extensively for oil, and it's going to be a real flashpoint. We're already seeing squabbling over the Diaoyu Islands between China and Japan. Neither of them really cares about the rocks. What they care about is that they're vast oil deposits that would fall within the territorial boundaries of those rocks in the East China Sea. So there's a lot of tension in the world right now over oil, and this is something we have to keep our eye on because world economy needs to grow for all of these rescue operations and bailouts and money printing efforts to work. Oil is required for growth. For whatever sets of reasons, oil isn't growing on a worldwide basis, and that explains a lot about where we are in this story.
So, Chris, there are those that have the opinion that the emerging U.S. Energy industry, pointing to the great economy that exists in North Dakota largely as a result of energy, are also bullish on the U.S. economy, saying that energy will lead the U.S. economy to recovery. And yet, when you look at debt levels, not only at the federal government level, but in the private sector level, that seems to lead us to a different conclusion as far as the economy is concerned. So what's your take?
The energy additional supplies that we're getting out of the shale plays are absolutely going to mitigate and be helpful to whatever happens next. The idea that they will rescue us completely and allow us to just carry on our old trajectory is an idea I completely disagree with. And it's largely for the primary reason you mentioned, which is that we are still carrying as a nation around 360% debt to GDP overall. And it's an extraordinary debt load, and that's a massive headwind. And the second thing is that, once again, let me repeat this, oil is a world commodity. It's a global substance. And so even if we're producing more of it, we're not going to pay less for it, because as long as the United States is importing oil from anywhere in the world, that's the price we're going to end up paying for it. And even under the most bullish, optimistic, wild-eyed, scenarios I've seen for our production, we're still going to be importing, even under the most favorable circumstances, the United States will still be importing roughly a third of its petroleum. And that means that we are still exposed to whatever the world price for oil is. So it's good that we're getting increased production, but does it give us the cheap energy we need in order to continue to grow our economy in the way it used to grow, the cheap energy we need to support the interest payments on all of the outstanding debt that already exists? The answer is no. The shale oil that we're getting is great. It's expensive, too. And we are also tied to the world price of oil. So all new oil finds today require a minimum of $70 a barrel to get out of the ground profitably, and as high as $100, $110 a barrel if it's really tricky stuff. So that's the new price band for oil. We're probably never going below 70 unless there's a major depression and things just really crunch. But all systems go, oil's going to be 70 to 100 bucks minimum, and there's a lot of danger, risk that it could actually go a lot higher than that. So the risk actually compounds a little bit. But back to your original question from your commenter is, absolutely, this is a great place to be invested in. And if you're investing in industries that are in North Dakota or Texas, those places are going to be absolutely hopping for as long as those shale plays last, which will be decades.
So, Chris, let me go back and revisit the whole idea of identifying some source of cheap energy. The whole Solyndra fiasco, that's, I guess, more my opinion than fact, but certainly there's been a lot of government backing of green energy, which, from my perspective at this point, just doesn't seem to be economical. You drive around the country and you see a lot more in the way of wind farms than you ever did 10 years ago. Are these long-term the direction that we'll have to go for cheap energy, or from your research, is there a better solution?
There really isn't, Dennis. Fossil fuels have been an extraordinary bonanza. They're just wonderful, wonderful energy sources. They are dense. They are stable at atmospheric temperatures. They do what we want them to do. They're really just absolutely miracle substances. When we talk about any alternative energy, we are by definition talking about something that is less dense, has less energy density, so it's a more diffuse energy source, which by definition means the capital costs to extract it are going to be higher. And that's going to be part of it. Now, I truly believe the future lies in figuring out how to use what energy we do use more efficiently. The answer is, could the United States have a completely wonderful, thriving economy that's very prosperous, consuming half the energy per capita? Of course it could. Europe does it, and they lead perfectly good lives. So I believe that the way of the future involves using what we have as carefully as possible. Efficiency is going to really win out. Companies that use energy more efficiently are really going to be defining the future. And there's whole trends that are going to go in play there. And I think Amazon potentially is the beginning of that model, where instead of each person driving to a store to get the one or two things they need, everybody sort of orders from Amazon or something equivalent, and then one truck drives around and delivers all those things. I expect to see that trend sort of increase over time to the point where, shopping may well be something that's a lot more rarely done on the hoof, as it were. And so, that's a big trend. So I would, under that circumstance, I wouldn't be as bullish on shopping malls and commercial real estate that's, sort of scattered at the periphery of major cities. I'd be more bullish on the idea of finding out who is able to deliver products to people at the most energy efficient way possible, because that'll ultimately translate into cost efficiency, and that'll mean price, and that'll win.
Chris, last question. We've got about 2 minutes left in this segment. You've given us your outlook for gold as well as energy. Where do you think the major U.S. stock market indices are headed in the weeks and months ahead?
Well, I think there's a very high risk of a disappointment in the stock markets, but that's not just fighting the Fed. It turns out that's fighting all of the central banks out there. Bloomberg had a nice article up today that talked about how central banks are now buying equities directly. So Bank of Japan is doing it, certain other banks, Swiss Bank, I believe, Swiss National Bank. So imagine this. You have central banks that print money out of thin air, and they're buying mortgage-backed securities with them, and they're buying equities with them. It means we've enabled one class in our overall societal structure to manufacture money out of thin air and buy real things with it. It's really rather an extraordinary power. And so the question really is, rather than do I think equities are fairly valued or overvalued, it's less relevant than asking, do I think the central banks will give up on their printing ways and sort of throw in the towel on this anytime soon? That puts us all in the speculator camp, so I'll speculate. I do think that for the Fed to do more, it's going to need an excuse to do more, and that excuse might come in the form of another financial crisis or lower equity prices or something that allows it politically to do more than it's already doing. And because I don't think in the United States we have the political will and fortitude to print like Japan did. Japan finally reached its breaking point, got a new prime minister in. He asked the old central bank governor to leave and got a new one, and now they're printing like mad. I think we would need some sort of an event like that to do that. So really, this is a very sorry answer for me to be giving at this point, because I hate the idea that I am openly speculating on whether banks are going to attempt to print our way to prosperity or not. So if you ask me long term, can we print our way to prosperity? Will the central banks win? And the answer is absolutely, unequivocally no. It can't be done. And history proves that, common sense proves that, but even math can prove that. So I think that we're on a really dangerous path here, and the risks are very, very high, and that circles me back, unfortunately, back to gold and other hard assets that have really tangible intrinsic value.
Well, I certainly didn't want to try to pin you down, but there's an old cliche that's very true, that the what is a lot easier to predict than the when. So
absolutely.
We will leave it there. Chris Martenson, thank you for joining us today. Appreciate that, and we hope you'll come back.
Thanks, Dennis. It's been a real pleasure, as always.
We will return after these words.